mother warned me last night.
Dad, you know Mom's not here. What's the matter? We'll take away your wings? You think you can do and say whatever you want?
You know where the door is, my friend.
What's your problem, big guy?
This place is changing. Opportunity, I think.
Morning, Trevor.
Morning, Bill. Sorry, I'm running something going on with my computer screen here. All right, I'm going to digress and go into music mode.
It's a beautiful morning.
Oh, it's great out. It's going to be a great day. I got lots and lots and lots of content today, so it's
address as usual. Like everything I say, make sure there's nothing that comes up that you're saying the client's buying it is owner occupied, and there's a listing to rent it out right away from right after they buy it, or make sure it wasn't a student rental before. Make sure it wasn't a grow op before. These are all things that have come up from experience that I'm sort of saying. So make sure what's going on. If it's a private purchase, just mention who's buying from who, and make sure that there's an actual deposit on offer, and you're good to go. Like we can do 99% of the things as long as we know what's happening and you've sort of addressed them. Don't leave it up to us to try and figure it out, because that, again, it won't end well. Paul's super busy, and it just helps him do his job better. All right, I think we're on helpful hints now. Oh, down payment. Again, make sure you have all your down payment information. That's also one of the things I would say with income, you get down payment. If you can't get down payment, explain to them what they should be doing with their down payment. These are your clients. You have to coach them. Tell them to put their money in one account and leave it for 90 days. Tell them not to be moving it around, not to be doing bulk deposits. If there are bulk deposits, we're going to need to know where the money's coming from, and then we'll need 90-day history of that money. Like it could get super confusing when they're moving money around from 4 different accounts. Normally we have clients who go, oh yeah, so I lent my friend, $10,000 a couple of years ago. He's just suddenly sending it back. That's a bit of an issue. Again, not that I know this is recorded, so I shouldn't be saying this, but there are ways around that. But you have to be, before you send it in or say anything, you have to address that. That's why you call me and Dominic beforehand. Great, I'm gonna get in trouble for this. That being said, we want to try and help you guys. So again, find out what's going on. If the money's coming from overseas, that's not a problem. We can get confirmation of how that we need 90-day history from the account back home. We need confirmation of the wire. We need confirmation of the deposit and the gift letter. So we can definitely do it, but we need to know what's happening. And we're gonna see the wire. So again, if you question anything, the BDMs are one of your best resources. Before I keep going on, Dom, is there anything you wanted to add? I apologize. I've sort of just been talking nonstop.
No, not at all. You know what? I was going to wrap up with a couple things, so let's keep going, Samir, and I'll just wrap up with some final thoughts. Okay?
Perfect. I appreciate that. All right. So in terms of the helpful hints, we'll just go to the next slide because it's repeating majority of this. All right. So make sure that you have addressed everything that you're doing in the deal. If they're doing a refinance and you're taking out $500,000, I'm going to need to know where that money is going. It could be for investments. It could be for the purchase of a property free and clear. I might want to, have the lawyer address that money or hold it in trust till he can move it. If there was weaker credit because they went through a separation in the past, mention that. If the clients are mat leave, obviously mention that. Everything we can know that you think we should know, make sure it's in your notes. Don't bother. If the guy's a salaried client, you don't need to go into detail in your notes with like 4 pages saying, oh, he works here, he's worked here for 16 years, he's full-time. You can put down full-time salaried and move on with that. Use the notes for what they really are there for, to address any weaknesses in the deal or anything the underwriter might not pick up right away, to bridge the gaps. Quick closes are something that's super hot right now, and it's coming up more and more. We ask that all deals at least have a 2-week closing period right now. It's normally we could do it quicker. I just don't want to risk saying we can and then we can't, and then the client's so liable for it. So we always say 2 weeks. With a quick close, you need all documents up front. We need to know why we're getting the deal so late. We need to know if the deal's been anywhere else. We need to know what the situation is with the client. So you need to find that out, because a lot of times when you're getting quick closes, that can be where people are trying to, pull something on you. So you have to do your due diligence. It could be that they bought a new build and they were just told that it's being registered. That makes sense. But if it's a purchase and they signed the purchase agreement 3 months ago, where have the clients been? Why have they gone to anyone else? You need to do your due diligence, not only to protect us, but to protect yourself. Stop copying old applications. that one is important because it just confuses things when you don't end up updating everything, and then Paul will come back to you with questions. But apart from that, you have all these slides. You can go over them. You can start building these good habits of addressing everything in your notes or Googling everything, so Paul has an idea before you do. So let's let Dom sort of wrap it up. You're muted.
Sorry.
Dom.
Yeah, I'm muted. Sorry. So just some final thoughts. Samir and I have been in the business a very long time. I'm going on 20 years in the broker industry. I need all of you to have confidence in your sales abilities. Mortgages are commodity, but you are not. You're a sales professional. So the thing you need to understand is that you're selling a relationship, but you're selling expertise as well. And don't think for a moment that the guidelines are any different anywhere else, because the guidelines are pretty much the same because of B20. The government is basically mandating that all lenders basically follow the same guidelines and adhere to the same guidelines if you're a lender. So just always remember that you're not a commodity, you're a salesperson. Mortgages are a commodity, but you have to sell your expertise and you're professional. The broker industry is one of the fastest growing industries in Canada. I came from a bank. It was the #1 growth channel at the bank I was working at. So just always remember that everyone is trying to capture this market share, but you have a one up because you're selling expertise, and never forget that. And you're selling a relationship that you're going to have. And the longer you're in the industry, the better you're going to do. The second point I wanted to make is that on fraud alerts are something that's put there by the client. I've run into this numerous times. Brokers say, well, I don't know why that fraud alert is there. Well, the client put that there. And it's important, if you see a fraud alert, make sure you're reviewing the credit bureau very carefully, because fraud alerts can be a detriment to a file. So we, as underwriting, must contact that client and have a conversation with that client. That fraud alert will be there for 6 years, as you saw from the presentation on Equifax, and the client put that there. And it's very important that their phone number is up to date and that we contact the client. So the last point I want to make is about manual TDS and GDS calculations. What I wanted to do is send Trevor, I don't know if you've covered this off, Trevor, but if you have manual GDS, TDS calculations, I strongly recommend that you understand that and understand how to calculate that, because you would be surprised how many times you need to do manual GDS, TDS calculations, pen to paper, basically figure everything out, old school, and you'll be surprised how useful that calculation is. So that's all I wanted to say, but have confidence in your sales abilities, and never forget that you're a professional and that you have the ability to really capture a lot of market share as a broker. So thank you.
Thanks, Dom and Samir. And Dom, I would welcome that calculation. We do have something a little later today with the formulas in there, but anything you have, if it's better, we'll add it in and
Okay.
replace it with what we have. So appreciate that.
Thank
pal.
you.
And Samir, did you have anything you wanted to wrap up with, or?
No, Dom covered everything. Thank you guys so much, and good luck. You joined a great team, and you're going to be super successful. You just have to sort of keep doing this. And I know the first 2 years are probably the hardest, but that's really when it starts rolling from there.
Good stuff. Well, thanks again, Dominic and Samir from First National, our top lender, one of our platinum partners, and one of our platinum friends as well. They will be back here on Friday as well. On Friday, just sort of to set the stage for Friday, every Friday, the first 4 Fridays of this program are velocity training. All the programs are recorded. I got a little bit late on the recording today, so it came in halfway through Samir's presentation. I do apologize for that. I had some technical issues going on myself, but we didn't miss anything important. I don't believe it was really just the initial 2 slides, actually. But every Friday is velocity training. At the end of every Friday, we'll open it up for questions and answers for the entire week. Every Friday, we send out a recap of the entire week, and then we also load that into the FCF portal for you, and it's under Rocket Fuel 2.0. I believe they're going to change that, because right now it's Rocket Fuel 2021. So the recordings are all in there as well. And as we find any pertinent presentations or information, we will load that into the section as well. So every Friday those updates come. look for your emails for a recap, but it will also be loaded. If you missed the email, it will be loaded to the portal as well. So thank you again to First National. And we will get right into it. So it actually goes hand in hand with what our friends at First Nat were talking about today and the presentation that we had prepared for you. And really, it's all about the mortgage documentation and understanding sort of the language that we speak in the mortgage space. And it can be a little bit troublesome for those that haven't been in the mortgage space and you're really, really good salespeople and you're coming in here and just like, what the hell is that concept there? What's that, what's LTV or what, those sorts of things. So we're going to go through some of that today. And then you'll also have a glossary that will be sent out to you as well on Friday and then be loaded into the portal with what we call mortgage speak as well. But I thought it pertinent today to go through because you'll hear a lot from our lenders on the different documentation that's required, but maybe you haven't seen that documentation before. And I'm a very visual type person. I think it's great to, talk about the things, but let's see what it looks like. So when you have that document in front of you, you can sort of say, hey, I know what that is. And so we hear often, about employment income is a major part of getting a mortgage. And so there's different types of employment income that you can have, whether it be salary or hourly. But then we also hear self-employed or BFS, business for self. And so there's different documentation that's required for each. So a salary or an hourly person's pretty easy where you can get a pay statement or a couple of pay statements. You can get a job letter and potentially the last couple of years of T4s just to confirm their average income over the last couple of years. Whereas self-employed, there's a multitude of documents that you may or may not need to provide. T1 general being one, NOA or notice of assessment being another one. If the person is a sole proprietor, then the T1 general and the notice of assessment would be acceptable. If they're incorporated, they may pay themselves a little bit different, i.e. dividend income, or they may T4 themselves. And so a lender may ask for not only the T1 general and notice of assessment, they may ask for the corporate financial documents, which are almost like a T1 general for a corporation, but they may also ask for the individual's T4s as well. So these are the different nuances that you need to know when it comes to incomes. And so here's just a sample look. I just grabbed a screenshot. This one's from Winnipeg. So there'd be some different taxes on there, but the same basic idea of what a pay stub should look like for you. It should have the employee's name on there, potentially the employee ID, depending on how the company runs. There should be a pay period in there and the pay date. You should have, I think you can, just give me a thumbs up if you can see my mouse moving around there. All right, I think you guys can see it. Okay, so their regular income and what their rate is and how many hours they would get paid if they had any overtime. Now, when it comes to overtime, and our lender friends can correct me if I'm wrong, but generally they'll use an average, and that's where the T4s would come in. So over the last couple of years, if they've consistently done X amount in overtime, then that could be calculated into the total income as well. Am I correct on that, Samir?
That is exactly correct. We use a 2-year average for the overtime and we go from there.
Perfect. At the bottom here, now this is sort of important. So if your customer tells you they make $80,000 a year and you're showing a pay slip from say November and it's only this amount here, well, I don't think they're going to make another $40,000 in a month. So these are things to pay attention to. What a lender also looks at is what the deductions are to make sure that it adds up to the income that you've put onto your application, their net pay, and then their totals and deductions. So all of these things would add up. And these are things that lenders and underwriters will look at to make sure that your customer is, the income that you've claimed or put on your application or they've put on the application is the same as what the pay stub would be. Here's a sample of a job letter. It should always have some sort of a header of the company and how to find the company and those sorts of things, where the company is located. Each company nowadays should at least have some sort of a web presence. I'd be surprised if they don't. The date of the letter, again, who it is, and then all the pertinent details for that particular employee, how long they've been there. Employers don't necessarily get into dependability and reliability. That's more of a letter for, say recommendation or something, but it's in this particular letter. And then as Samir alluded to in his presentation, you would want to have that signed off by an HR person or someone of authority. And here's a sample of a T4. Just gonna fix my screen here for a second. And so there's a couple of spots to pay attention to. So ensure the document is titled T4. That's very important. There are all sorts of different T numbers. There's T5s, there's T4As, there's those sorts of things. If this is a salary or an hourly type person, you'd want it to be T4. Employer's information should be up here. And then the contact information should appear in this area. And then there is a section for the income, and I believe it's right here in box 14. In terms of fraud, I don't know if they've changed the T4, and this is just a note, but they do change around the boxes from time to time just to eliminate fraudsters from making up documentation. And so moving right along, here is, now we're talking about business for self. So we've sort of gone through the salary type hourly documentation. This more gets into your self-employed individuals. And so your T1 general, this is the standard sort of cover page. It should be about 4 pages. Again, you'd see the title of the document here. Your contact info, or the borrower's contact information would be here. If they were married or had a common law spouse, that would be in here. I don't have screenshots for the next couple pages. Traditionally, it was line 150 would show your net income. I believe it's gone to line 15,000, and that'll continue to change over the years. And so that would be on page 2. And again, like I said, generally there are 4 pages to a T1 general. There could be more depending on investments, income and that sort of thing, but generally 4 pages. Here's a cover page of a notice of assessment. Again, contact information, the date of the statement, and then, you know, if there's a refund, those sorts of things, in a summary as well. Now, a lot of folks nowadays will have what's called I think it's called My Account with CRA. They can literally go online and retrieve their notice of assessment. As you may or may not know, we also have access to NOA, where a customer can subscribe or allow you access, or the lender, and you can get the NOAs as well fairly quickly. And so just a description as to, you know, what these are. What is it? A notice of assessment is completed by the government of Canada. Once you've filed your taxes, your T1 general documentation would go into the government, and from there they would assess everything and send you back your notice of assessment. You may or may not owe taxes, and this is you personally or your customer. And from there, I would say either a refund or a nil, or you owe money. I'm just going to check the chat to see if there's any pertinent questions around this. And if you do have a question, I don't mind if you unmute yourself one at a time. It's hard for me to do chat and present at the same time. So hopefully, let's see. Okay, so it looks like, how do we show income for a client on a 100% commission job? So one of our team leaders or managers want to jump in on the last question here. I see Elaine. I'm not sure who's on here. I'm sort of flying blank here. I don't get a chance to see who's on. But does somebody want to touch that one on how do we confirm income on a 100% commission job?
You would ask whether...
Samir, I'm just going to, maybe Megan can jump in. Is that okay? And then maybe you can, Samir.
Perfect. Yeah.
Thanks, Megan.
So it kind of depending on the commission that they're receiving or where they're getting it from, but you would look at their T4A that they have for their commission statement, as well as their T1 generals. Any lender is going to want at least a 2-year average of that. And typically for commission, they're not going to allow any write-offs. For instance, with us in the mortgage industry, we can't add back our write-off. So it goes off right off our net business or net commission income, not your gross.
Awesome. Thanks, Megan. Appreciate that. Samir, did you want to add to that?
No, she covered everything. It depends, because some people are commissioned and they're self-employed commission, and then there are people who are commissioned working for a company. That's the only difference that I would address, but that's pretty much it. You get that's how I'll go with that.
Perfect. Thanks, Samir. Thanks, Megan. All right, so we'll carry right forward here. And so we talked a little bit about income and the different types of income. And now we're going to get into down payment. And so as Samir talked about in his presentation, if somebody's purchasing a home, they want to see that that down payment is in the account or accounts for at least 90 days, whether it be a savings account or an investment. Other forms of acceptable down payment would be a gift from a parent, and or the sale of your previous home as well. And obviously the equity would go towards the down payment of your next property. And so I figured I'll just sort of put a snapshot in here of what a bank statement would look like. It would be, whatever the party is. In this case here, I've picked a Royal Bank one, and the account statement. The borrower's name would be on here. The period of which the statement would be. Now this could be also an electronic, so your client can go on their online banking and actually print these off, or print to a PDF and send them to you. There'd be a summary of their account information, and then all the details of it. Now, the one thing is, a lot of clients may or may not have done this in the past. You want to ask your client not to redact things on their bank statements. The lenders don't want to see things redacted from a bank statement. They want to be able to see everything. Sometimes, on a skinny type deal, a lender may be looking at habits too, as to where, your borrower is spending their money. I don't know if it makes up a full decision, but if somebody's, maybe going to the casino, every single day type thing, it might raise a red flag for a lender. And, depending on their policies, they may decide not to move forward with that deal. And that's just one example. It just came off the top of my head. But anyways, here is a view of a bank statement. And so I just took a quick screenshot of a gift letter. And this is someone who is giving X amount of dollars to John Smith. It's an unconditional gift. It's used to purchase a property. You may or may not want to put in the address of the property as well. I would suggest probably putting in the address of the new property. And the fact that the gift is not repayable or refundable is important as well. So now the lender knows when they're looking at this is an actual gift, and it's not some sort of a loan that's being arranged. The the lender would want to sign it, or the gifter would want to sign it, and then put their information on there as well. And then we move into investment statements. Most of us would probably have investments, so we've seen some of these documents before, but also just thought it would be pertinent to put a snapshot in there for those that may have not. Again, the investment company would be up here with the borrower's information. There would be a period in there of where the investments, the capture, the portfolio value, and then a breakdown of the values and the different investments that are there. So when a lender is looking at this, they may say, okay, well, these are cashable dollars that can go into cash without any penalties. If this person, maybe it was an RSP statement, and maybe they're not a first-time home buyer, there may be penalties to withdraw money for a down payment. A lender may ask some questions around that. So you really want to sort of think that through and look at the investment statement to see where the investments may be coming from for the purposes of a down payment. All right, and I'm just going to check time. Okay, so getting into another form of down payment would be a purchase and sale agreement. And so I've just grabbed one from the board of the Toronto board and a sample of what that would look like. Bill Cook, are you back on the call? I know his internet crashed, so. Okay, we lost him. I was going to have him sort of go through some of the nuances of a purchase and sale agreement, but standard stuff, buyer, seller, the address would go in here, the agreed amount for the purchase or the sale, and then some initials. Completion date is important as well. Irrevocable date, which means that it's become a firm deal, or you cannot revoke the deal. Standard clauses generally are in here. If there's fixtures, that are included, maybe a fridge, a stove, standard things like that. Generally, all the signatures would be on here. You may put in the brokerage's information, and they may put in the solicitor's information as well. And then any nuances to an agreement of purchase and sale would go in here. So any additional clauses that they may put in there. And then initials. Okay, moving right along. So there's 3 mortgage insurers in Canada. There's CMHC, there's Sagen, which is formerly known as Genworth, and Canada Guarantee. And so I was having a conversation on text about a week ago, and I want to thank Tom for this, because sometimes when you've been in mortgages for 20 years, you forget, you know, some of the things that if you're new coming into the industry that are, you know, we take for granted sometimes being here for a while, and they're just not prevalent to those that are new. So what is default insurance? Because we hear about insured, insurable, non-insurable, those sorts of things. So default insurance is here, and there's the definition. Generally, anybody less than 20% down would need to get default insurance. The insurance is a protection for your bank or lender if they had to take the property back. I put in a question here of is CMHC insurance mandatory? Again, it is for those that are 20% down. This is taking away from the description of insurable and those sorts of things. Default insurance or mortgage insurance is absolutely for those that are less than 20% down. If you're dealing with first-time home buyers, generally they're going to have less than 20% down, but there are people all over that, you know, have less than 20% down. You really, really, really need to understand insurance when you're explaining that to your client and they haven't heard about it. Remember, we're the professionals and we're the ones that need to explain these things and understand it before we explain it. And so here's a list.
Mortgage. I'm unable to take the call right now.
Okay. I wasn't calling anybody. Anyways, okay, so here's a list of the premium charges. Now, keep in mind, CMHC, Genworth, or Sagen, CMHC, Sagen, or Canada Guarantee Insurance is added to the mortgage balance, but the customer will be required to pay the provincial tax. In our case, it's PST on closing, and it's important that you know that. It'll also become part of your disclosure to borrower, which we will be going into next week. And I don't know what happened to my slide here. Oh, there we go. Okay, so an insured mortgage is a mortgage covered by mortgage default. The insurance is purchased to protect the lender, and so we've already said this, against any losses related to default or foreclosure. A high ratio mortgage is a mortgage loan higher than 80% of the lending value of the property. A conventional mortgage is a mortgage that is up to 80%, but that has changed. An insurable mortgage. So now there's a difference. So an insurable mortgage. So back in my day, it was high ratio and conventional is very simple. And again, I date myself all the time, but insurables come in, and our lender friends or our team leaders, managers can correct me if I'm wrong on this, but I believe in the last 4 to 5 years, insurable has come in and non-insurable. So an insurable transaction is that is portfolio insured at the lender's expense for a property valued less than $1 million that fits insurer's rules. So the same rules apply as a high ratio mortgage, but it's an insurable type deal. Now, when you're looking at your rate sheets, you're going to see high ratio rates, you're going to see insurable rates, and you're going to see non-insurable rates. And so you really have to understand the differences. And there's uninsurable, a mortgage that does not meet the mortgage insurer's rules, such as refinances or mortgages with amortizations longer than 25 years. No insurance premium will be charged in those cases. And so I'm just going to quickly go to chat to see if there's anything pertinent here. Okay. All right. So I thought it was important today to just jump into, and I know we're getting right up on the hour there, so I'm going to skim through this. These definitions we're continually working on, and we actually had a team of team leaders and managers that helped with a lot of these definitions and putting it together, and it'll be a living, breathing type thing. But I figured for the purposes of today, I'll go through a few of what we like to call mortgage speak, or our language that we use. and some of the sort of acronyms that go along. So loan to value or LTV, TDS, total debt servicing, gross debt servicing. I know Dominic suggested he may have a calculator or a formula for us. So if his is better, then we'll replace that here. We talk about mortgage suitability. So we talked about that, I believe, on Monday, suitability. And so here's all the things that you would want to consider when getting into a suitable mortgage for your borrower. Mortgage term, amortization, mortgage commitment. What is that? MLS listing. And what is that? Pre-approval versus pre-qualification. Deposit, down payment we've talked about. Closing costs. And what should a customer or a borrower anticipate in terms of closing costs? Closing costs generally include land transfer tax, legal fees, any taxes related to the mortgage, those sorts of things. Letter of direction. What is the stress test? Beacon score. And again, that's from the credit bureau. Bear with me here. I'm having somebody I hear typing. If you're unmuted, if you don't mind just muting yourself, I'm getting sort of typing feedback here, please. Thank you. Bridge financing. It's a sort of a common term that comes up, and just understanding bridge financing and then how it works. Rate hold, we'll often see that. Rate buy down, what is that? Condition of financing. So inspection is one. Get into a purpose of a loan. So a purchase, a refinance, a switch. Types of rates, we have fixed rates, we have variable rates. What is APR? Open and closed mortgages. What's a HELOC? Different types of mortgage types. So I just sort of went through that. Insured, and then you have your CMHC, Sagen, or Canada Guarantee. We have insurable, we have uninsurable, and then what is an uninsurable mortgage? Types of mortgage, we have first mortgages, we have second mortgages. I didn't get into third mortgages just because first and second mortgages tend to be more common. When you're getting into third mortgages, we can have discussions around that. I would strongly suggest you talk to your manager, team leader, or Bill or myself about that. Blanket loan, and what is that? You may hear that term and so you want to understand what that is. Rental property, commercial mortgage. You'll hear subject property, second home, joint tenant, tenant in common. What's the difference? Then you have your registration types. Standard charge mortgage, you'll have collateral charge mortgages. And sort of here's a definition further down for a collateral charge mortgage. You'll hear the term asset liability, net worth. We talked a little bit earlier about types of income, employment income, retirement income, support payments, rental income, investment income. There's all sorts of different types of income. Stated income you'll hear. BFS is a common term we use, business for self. What's a bankruptcy mean? What's the difference between a bankruptcy and a consumer proposal? What's the difference between a foreclosure and a power of sale? We here in Forest City, we use two submission applications, Velocity or Filogix. You'll hear the term monoline, fulfillment specialist, underwriter, funding officer, just a brief description of what each of them would do. BDM we hear often, and that would be considered Dominic and Samir on the call. BDM, Business Development Manager. Some lenders will have a different acronym, but same idea. A lenders, B lenders, private lenders, commercial lenders. You'll hear the term often MIC, Mortgage Investment Corporation. Generally, these are private lenders and they're pooled money. We have credit unions, banks, trust companies, MICs, private. You'll hear the term fees. So you'll hear lender fees. So if you're getting into alternative type lending, the lender may say, hey, we're going to give you a rate of 3.9% and a 1% fee. Well, that's a lender fee. And so the lender will be charging a fee. They may say we're going to do a 1% fee and a lender split, which means that they would pay you X% a split on that deal. Oops. Then you have a broker fee. And so a broker fee generally we're doing that when it comes to private mortgages where the lender is not paying us for our services. And so we would negotiate a payment with our borrowers. Generally, rule of thumb is 1%. And here's just a quick view of what a letter of direction would look like, where you'd put the lawyer's information in there, you know, the application number, the client's information with the pertinent details, the loan amount with the interest rate, all of those details generally would pre-populate for you, and the agreed upon fee that you would put in there as well. And I believe that is right, goes in right in this section here, if you can see my mouse. And then your customers would authorize that with their signature. You would then send that over to their solicitor's office, and the solicitor would collect the funds for you on closing. You'll hear appraisal fee, and you know, if you can AVM, I'm going to add that into this, but AVM would be auto valuation, but appraisal fee, sometimes they run between $150 or $500 depending on the area. And again, it could be higher than that again, depending on the area. Land transfer tax, and understanding that if you're dealing in Toronto, there's an additional land transfer tax. You need to understand that. The good thing is our mortgage app will help calculate some of those land transfer formulas. There's some exemptions when it comes to land transfer and understanding those. And then the formula, I just did a screenshot of our mortgage app. My Mortgage Toolbox will have a calculator in there for you. Understanding title, guarantor. You'll hear E&O quite a bit, errors and omissions. What is title insurance? So FCT, as an example, First Canadian Title. They're an insurance for borrowers' title on property. And then first-time home buyers. And so here's sort of the incentive and one pager on first-time home buyers. And so this will all be available. Plus, like I said, it will be a living, breathing document. It'll actually be a separate document loaded into the Rocket Fuel platform there, and then we'll continue to add to it. It's something that you'll always be able to go back on. So if you forget something or you've heard a term, it may be in here, and it should be in here. And so what I will do is go to chat, bear with me. And I'm going to just unshare my screen so I can actually see people. This would help me a lot. All right. So, Bill, do I have you back, Cook?
I am back. Thanks very much.
Perfect. All right, good. So I was trying to sort of keep within our time frame. I want to make sure, and I'm just going to reiterate this, all of those terms will be available in our portal as well. And we'll continue to add to those. And every Friday, we will send a recap of all the calls, inclusive of the velocity training. So for those that, you know, maybe got tied up or something, you can always go back to that. Anything you want to add here, Bill? I don't know when you came back in. I'm just going to read through some of the chat to see if there's anything I missed.
No, I've been sort of monitoring it. The senior agents on the call can always explain the difference between variable rate and adjustable rate mortgages. Somebody like a Nancy Ingram.
Yep. Good stuff. Okay. Is there any further questions for us today then? This is my program for today. All right. Okay. So there's no further questions, everybody. Like I said, we will load this on Friday at 10 a.m. is velocity training. We will see you all there, and have a phenomenal day, everybody. And we'll talk to you soon. Have a great day.
There was one more question on the chat. Rates are going up. Any explanation? Hanny, rates are typically determined by what happens in the bond market in Canada. And as those trends tend to go up, it tends to affect interest rates as well. And that's what you're currently seeing in the marketplace. Again, Nancy or Megan, anybody else want to jump in and explain that? You're welcome to.
Well, I don't think there's any really explanation for that because I can't figure it out either, but it is going up. The bond rates are going up. But as far as the variable and adjustable, it's variable rates, but it makes a difference on depending on the lender, whether they move the rate every first of the month, if it moves. So they would typically increase your payment so that your amortization wouldn't be more than what you had to begin with. So it's a variable rate mortgage, but the payment actually changes. There are some lenders that don't actually change the payment. So it varies from lender to lender, but that's essentially what it is.
Trevor can speak to this more than me, but it's not quite as simple as this, but typically the banks like to maintain about 150 basis point difference between the bond yield and their current interest rates. And consequently, when bond yields start to go up, interest rates start to go up. And that's what you're seeing in the fixed market right now with fixed interest rates in the marketplace. There's some upward pressure on rates.
Yeah, and that's actually very, very skinny nowadays. It's not even the 1.5 anymore. You're operating on a 3/4 of a basis point in some cases now as a lender. So
Really nice when you can control your own profit margins.
yeah,
First notwithstanding.
perfect. All right, everybody. We will see you on Friday at 10 a.m. Thank you for joining today. Hopefully you got some value. And like I said, this will be loaded and a recap will be sent out on Friday afternoon. Thanks, everybody. Have a great day.